Welcome, Benzinga Nation. You know that anything and everything that we do here is to find ways to inform you of decisions and conversations that need to be had about the market so that you can make your informed decision on how to put your hard-earned money at work. And today, we've got a great interview, an hour-long webinar, if you will. It's going to be ETF Insights with Jay Hatfield, who we want to talk about in terms of infrastructure capital advisors, right? And we're also going to have Tim Melvin join us here in a moment as well. But Infrastructure Capital Advisors is a boutique financial firm which has about $2 billion. That's right, $2 billion in managed assets as of today. They're a leading provider of investment management solutions specializing in the ETFs, the private funds, and also providing consulting services for other investment firms as well. They've got a new strategy, a new ETF that I want to talk about later on here in the show as well, which is a small cap managed fund as well. So we'll talk about that with the income aspect to it. So with no further delay, let me go ahead and bring on Tim Melvin and also Jay Hatfield. Both of you, thank you so much for coming on the show. Really appreciate your time, Tim, and Jay. Welcome to Benzinga's webinars.
Thanks for having me on, Junaid.
Yeah, absolutely. My pleasure to be here as well.
And of course, both of you, I mean, you guys have been in the financial markets for, so many years. You have great insights on the ins and outs. And I feel like a lot of times when it comes to the financial markets on Twitter, where some of the viewers might get their information, or TikTok or whatever, they haven't really lived through the .com side of things or the 2008 crash and managed funds and been able to survive. So I'm really looking forward to the conversations that we have today. I know, Tim, you mentioned during our prep call about how Jay was one of the few folks that was kind of going against the grain when everyone was talking about recession. Jay, you kind of had a different opinion on the market outlook as well. So excited to kind of hear the conversations and insights from both of you. I will be in the back kind of just listening in, but I will go ahead and pop up and kind of see if I have any random questions. So Tim, the floor is yours. Thank you so much for hosting this for us.
It's absolutely more than my pleasure to be here today. And I guess we'll start off, Jay. InfraCap is a different kind of firm. Can you talk a little bit about, we'll come back and get to your background in a minute because I think that's critical, but the founding of the firm and the mission of the firm and kind of what your guiding principles have been, because I think it's important.
Well, we are fundamentally income investors, and we have a bias towards hard assets because they tend to be more stable through cycles and to deliver better, consistent income. So if you look at all 5 of our funds, they all have monthly substantial income. We have 2 equity funds. SCAP is our small cap income fund. ICAP's our large cap dividend fund. And then we have one other equity income fund, which is AMZA, our pipeline fund. And then we have 2 fixed income funds, both preferred stock funds. PFFA, it's our flagship fund, yields over 9, delivers monthly income. And then PFFR is a REIT preferred index fund.
Okay, now the investment philosophy of InfraCap comes 100%, I believe, from Jay Hatfield. Can you talk a little bit about how, because you approach the markets in a manner that I've seen from very few people in my 35 years, and remarkably, everyone that does it's been very successful, not in the short term, but also in the very long run. So can you talk a little bit about your overriding philosophy and approach as you come to the markets with these things?
Well, we do believe that you really can't pick stocks without having a good macro outlook. So a lot of investors will just come on TV and just say, oh, well, we don't call the market, but here's our stock picks. Well, certain stocks are going to work in certain markets. It's going to be driven by the economic cycle and interest rates. So we start with that, and then we get very detailed about all of our models, cover every company. We model most of the companies by asset, particularly REITs and MLPs, where there's a lot of disclosure. And then we talk to those companies, monthly, quarterly, updating models. So we believe in a value approach. We don't overpay for growth. A yield from stocks. We want to get paid to wait. And then covering the companies very intensively to avoid any low quality companies that are over levered. When you're looking to have good longer term returns, you want to avoid good problems or blow-ups. And so if you do all that work, buy companies at reasonable multiples, low leverage, then normally you're successful over time.
Right, and the key is you do have to do all the work, and that's one of the things that I've really enjoyed about getting to know you is not only do you do the work, I think you really enjoy the work, because every time I talk to you, almost no matter when it is, you're in the office doing the work. Now, you've been at this for a long time in the securities, but you industry, but you also have some very unique experience in the energy industry. So since that's going to frame up part of the conversation later, can you talk just a little bit about that?
Well, I started my Wall Street career out in Morgan Stanley doing investment banking. So I did utilities, energy, and MLPs. So that's kind of my core background. I do think it's an advantage having done investment banking because you understand the corporate processes a little bit better than somebody who's just observing it from afar. So if you've been in boardrooms, you understand the dynamics better. And then I also, after I launched my own firm, I've co-founded an MLP. It's publicly traded, NGL Energy Partners. And then our first flagship fund was AMZA, which was launched about now almost exactly 10 years ago, which is our MLP/pipeline fund.
Okay. Now, as you said quite correctly, very early on in this, a big part of succeeding as an investor is something most people don't do because it's work. But you've got to have a larger picture, macro outlook. And your calls in the years that I've known you have been unbelievable. They're almost always contrary to consensus opinion. And you have an amazing accuracy rate, I'll call it, for having a divergent macro view that plays out. So having said that, what do you see going on? We'll start with the stock market because that's the top of mind for everybody. What do you see happening in the stock market this year, 2024?
Well, I guess I'll take a step back because, again, it's hard to just talk about the stock market without framing it in terms of economics. And the main reason that we were really, it's almost the sole reason that we've been more accurate than most is unlike the Federal Reserve and many, many strategists and economists, we mostly focus on monetary policy and what we call the quantitative theory of money, which is basically the price levels determined by the ratio of money to goods and services, not the employment market. And therefore, inflation is caused mostly by increases in the money supply, and to a lesser degree, if the supply comes down, that ratio changes, and you have inflation. Normally, that's energy. So that's really the heart of it. And that's also the heart of why we're bullish now, is that it's not as clear in the US, but the ECB has announced they're going to cut rates. And what very few US investors appreciate is that they're 30% of the global money supply. And to cut rates, they have to inject liquidity, which should drive global stock and bond markets higher. So that's why we're fundamentally bullish. In terms of explicitly, we have a 5750 target on the S&P, which we think may be wrong because it's too low. But 21 times next year's earnings. It's important if you have a year-end target to use 25 earnings, not 24. So a lot of strategists will come out and say, oh, well, market share is trading at 22 times this year's earnings and ignore that, we're halfway through the year.
Right.
So, but to be fair, we have to be right about that macro, about Europe cutting rates, probably Canada before us as well. The money supply growing, driving rates lower. Because if we look at our fair value models, to get to a 21 times next year's earnings, the 10-year should really be in the 3.25 to 3.5 range. So we need a bond rally to get to the top end of the range. But I'm not very nervous about our target, even if we don't get all the way down to 3.25 or 3.5. Because this AI boom is the biggest thing that's probably happened in our lifetimes. And unfortunately for us, our lifetimes are pretty long. So possibly bigger than the internet. And people continue to underestimate it, in our opinion. And we're going to find out tomorrow. But I think Nvidia will beat and raise, maybe not up to the expectations. So you never know going in to an earnings report. It's always risky. But we continue to see these signs that this AI boom's for real. And it also creates a market where it essentially never goes down, because when the fundamentals are bad, like if inflation's rising or whatever other bad news there is, people buy tech stocks. If the news is good, they don't buy tech stocks and they buy the value and income stocks. So basically it's a market that is a really bad short. Like it always wants to go up and rarely down.
Okay, fair enough. Now, just to touch on real quick, the ECB rate cuts are a given at this point. And I think that's probably the case in Canada as well. It's getting a little murkier here in the United States. Do you have any thoughts on that you want to share with everybody?
Well, we've been correctly bullish about the U.S. economy for even through even in 22 when the Fed was raising rates. And the reason for that is that because of the pandemic partly, but also because of the great financial crisis, we have a shortage of housing and autos. And if you look, and this is another thing that very few people fully appreciate, every single post-World War II recession was caused by a decline in those two hyper cyclical industries, autos and housing. And it was, by the way, not caused by the consumer pulling back, because everybody tends to misanalyze the data and say, well, the consumer is 2/3, so they must cause the recession. They're 2/3, but they're very, very sticky. If you think about low-income consumers, they need to spend money. High-income consumers want to spend money. So unless there's a big dislocation on the investment side, they're just going to spend money. But when the Fed raises rates, it tends to clobber those hyper-cyclical industries. We haven't had any decline in those industries yet, but you've seen signs of weaknesses developing recently. Specifically, auto sales were terrible, down last month. Housing starts are decelerating, and the labor market's softening up. So we do think the Fed will cut probably in July, but that's about 50%, and then 50% in September. Inflation is going to cool some because oil prices have come down. That's another thing everybody ignores. Oil, even in the short term, feeds into CPI, particularly core. It feeds into every business, but there's certain obvious ones, or more obvious ones, like airlines. Almost all the volatility in airline fares comes from energy prices. So we think inflation will decelerate some, but probably not enough for the Fed to cut. But if the economy starts to decelerate, particularly the labor market, then we will set up for a July cut and probably 2 cuts this year.
Probably 2. That was going to be my next question. I know coming into the year we had 5, or some people had 6 cuts baked in. How many did you see playing out this year? Because I mean, the Fed's really going to be the last one to the party, because it looks like almost everybody else in the world has already either started cutting or has announced cuts. Am I missing something there?
Well, the rest of the world has one advantage over the U.S. They can properly measure inflation, which we cannot. It's sort of hard to believe, not even sort of, it's really hard to believe that we deliberately delay our shelter calculation by 6 months. Like that's just the methodology. Like they only update 1/6 of it every month. So it's just by definition 6 months behind. And then they use lease renewals as a big portion of that calculation. So that delays it another 12 months. This is one reason the Fed made this horrendous transitory call, because they didn't see the inflation yet in CPI because shelter's delayed by 2 years. So, but the rest of the world doesn't have a problem. So their inflation is plummeting, and they're going to cut first, but that should set us up to cut.
Okay, very good. So what's that going to do for, obviously it should be super bullish for bond markets. What does that do for, say, 10-year treasuries and high-grade corporates in here?
Well, we think that it's not going to be like the moment they cut, because this is the other element that's worth emphasizing. I mentioned it briefly. We're the only place, our website, www.infracapfunds.com. It's the only place where you can get the global monetary base. So that's all the money supply of all the central banks, the major central banks in the world. And that's critical to follow, because to lower rates, they have to increase liquidity. So it's not just like, okay, well, who cares? The Eurozone rate went from 4 to 3.25. That's probably not going to make that big a difference. But they might have to inject 500 to a billion into their banking system, flows into their capital markets, into equities and bonds. It's more the liquidity impact than it is just that 25 basis points. That's why people tend to underestimate the power of monetary policy. Like our best call, we weren't really putting this out publicly, so I can't really prove it. But some clients reminded me, is that we told people to start getting long, don't go crazy. But the second the Fed announced they're going to buy 1.4 trillion of securities per year, that just is like an automatic bull signal. It's like basically we're going to force stock and bond markets to skyrocket, which they did too much of, and we had the not .com, but SPAC bubble, meme stock bubble, a run up in Bitcoin. So they overdid it, but that's the key indicator. If you look at our website and just followed the global money supply to track to drive your investing, you would have invested nearly perfectly.
Actually, I'll go ahead and verify that call, because I actually remember having the conversation with you when you were in your office in New York. And I don't think you were even supposed to be in your office in New York, and you were in.
I was the only one.
Right.
In Midtown, there was me and Shake Shack. 5 homeless people, a guy who worked at Shake Shack. Shake Shack stayed open, God bless him.
Yeah, because I actually remember you and I having exactly the conversation that you just had. Now, I want to mention something here that I think is important for people to realize. Jay and his team do publish on their website, he just gave you that, InfraCap.com, their economic research. It's cutting edge. It's as good as anything anybody else, and in most cases better and more accurate, and has been of more predictive value than anybody else that I'm familiar with on Wall Street. Jay, how much are you charging people to log on and take a look at that?
Zero. It's a service to our clients. I mean, right. I came from the investment banking side where you have just a few corporate clients. So you, of course, treat them all like they're, royalty. That's what we do. We have a lot more clients, but we do the same. So the primary service we provide is doing great portfolio management. So that's what we're mostly focused on. But we provide information free for our clients and do research, our economic research. And we also will answer any questions you have. This is both retail and institutional clients. And so, that's a service we do provide.
Right. And I will say, Jay, I've been on several webinars and broadcasts with you where you just hang around and take questions for almost as long as anybody wants to ask them. You're one of the most public friendly fund managers, I think, in the business today. But jumping along, because I don't want to get too far behind. You and I have a history of going down rabbit holes. How about your commodity outlook? Because that's going to drive a lot of the interest rate outlook, which will drive the fund flows, which will drive market. So how do you see the commodities market? Gets a lot of headlines with very little information today.
Right.
So,
well, oil is where we have the best research. Frankly, gold and copper are a little bit harder to explain, but oil's a little more rational. We're bullish, constructive on oil, but we think it got ahead of itself. WTI was up to $90 a month ago, but our range is $75 to $85. I'm sorry, $95, so 85 midpoint. And the reason the range is so large is that there's just a lot of noise in the oil market. Like I got a question from a reporter this morning. Well, why is oil down today? There's really no reason why oil is down. It's just down. It's in a downtrend. Commodity futures funds trade with momentum. It's going to go down until it bounces, and then they'll start trading it up.
Right.
But in the short run, it is bullish for inflation. We do think it'll rally during the summer. Typically, it gets ahead of itself during the summer. The summer is great for energy usage because of the travel season. And travel's not like the winter. Like there's really is not affected that much by weather. And also when it comes to natural gas, it's reliably hot during the summer, whereas it's not necessarily cold, I guess, particularly with global warming. But even in general, before global warming was as big an impact, the weather is much more volatile during the winter than it is during the summer. So you have reliable demand for electricity, travel fuels. That's likely to accelerate this year as people are traveling more out of China. So we would expect oil to trend up throughout the summer. I won't be bullish for inflation, but the near term, it is bullish. We'll have a couple of cool prints, most likely on CPI and PCE, not this month, but the next following 2 months. PCE is going to be relatively hot this month, but the following 2 months.
Okay. Now, you said something important there about travel out of China. Most of the press and the media and the talking heads and the pundits, and they've all written China off. China's collapsing. The economy is not growing. The real estate market has imploded. Xi has lost control. They're not seeing any growth coming out of China. You are truly on this one a little bit of a lone voice. So talk about what's going on in China.
Well, what I think people miss about China is that they have one huge advantage over the US. They save 45% of GDP, primarily retail. They don't have a big safety net. So individuals save a ton of money. And the growth in either a company or a country is exclusively driven by the amount of savings and investment. Savings equal investment. So even if China invests poorly, but they're still investing 45% of GDP, let's say they do that at a 10% return, they're going to grow GDP at 5%. Well, shockingly, even last year, after all the regulatory crackdowns, property collapse, they grew at 5%. Now you could argue that they're playing fast and loose with the data, but nevertheless, they grew at 5%. Their oil demand increased, so that kind of validates that. And there's certain advantages of being a communist country, which we just saw over the last couple of days, that if there's a problem, they can just fix it without passing legislation. So they're putting capital into the housing market to try to stabilize that. But overall, the country continues to be strong, is in this great savings position, and is going to grow. I'm not recommending investing in it. We believe investing in capitalism, which is mostly the US, maybe a little bit of Europe if you like socialism, but not communism. Your property can be seized, it can be regulated out of business. But from a macro perspective, in terms of demand for metals, energy, China is a juggernaut and it will continue to grow.
Okay. Now, just one thing I want to touch on real quick, that we're going to move on and get into some actual ETF and structures and products that you offer stuff. But you touch on it in the slide, and it's a divided opinion statement. You talk about the great electrification of the world and why it's not working. Mm-hmm. Touch on that just real quick and what it means for the global economy.
Well, it's what happens with issues that become political is instead of the optimal case or approach being pursued, the most politically expedient case is pursued. So there was a utopian vision that we would stop using hydrocarbons in the next 10 years. But what that misses is that the only way to generate electricity in the short run, it's a potential for some increase in nuclear, but has the same problems, is that I was a renewables banker 33 years ago as the first one. But wind and solar have limited resource and their price is conditioned on the location. So you can't just put solar anywhere. It's best in the Southwest where there's deserts and better weather. And wind needs average wind speeds over 15, which may not sound like that much, but is very, very high. So there's a limited ability to develop these pure electric sources. And nuclear also sounds kind of sexy in a way, but the radiation and the waste is a huge problem, and nobody wants that. And you might be willing to have a solar, definitely solar, almost certainly not wind, but nuclear is not going to be something that people embrace. And they shouldn't, because it's very risky because of the radiation. So all these things are going to be minor contributors. So what we need is a carbon tax or cap and trade system to properly price carbon, and then the market will figure out whether it's carbon capture or is it conservation, insulation, or geothermal heat pumps. There's 100 other potential solutions, which right now are being chosen based on political considerations and not economic and environmental considerations.
Okay. Let's go from that. And there's in this accompanying slide deck, there's a bunch of economic slides and data and information, but Jay's really covered those. And I want to get into the nuts and bolts of some of the things that InfraCap has to offer our listeners today as investments and alternatives. And you're kind of in the income alternatives business, which I'll just throw out there bluntly. Most people don't even understand what that is, and they tend to think of income alternatives as utilities and REITs only. There's a lot more to that. So let's talk about equity yield alternatives, how sensitive they are to the market, and what choices people actually have.
Right. Well, what we do is we like to produce substantial income. So like if you look at our two equity income products, we add a little bit of preferred stock to those, because we do think, if you look at the data, preferred stock is a great asset class, is very low default rates, like 0.3 according to Moody's on average over the last 30 years. Really good yields, issued by public companies you can track, which of course we do very closely. But even you, if you are watching a particular company's preferred, you can look at their common stock. That's not true of high yield bonds. And so with these funds, we'll add a little bit of preferreds in. We'll pick, of course, dividend stocks. SCAP, all of our stocks have dividends, trade at reasonable multiples. We also, in most of our funds, not PFFA or R, but our equity income funds, we write very short-term covered calls, which is a lot of work, but a good way to enhance income. We do that, and ICAP is our large cap dividend fund. We do that on individual securities because they're very liquid and you can do short-term calls. For SCAP, we use index calls because they're super liquid as well. And also with small caps, you don't want to cap your upside because they can be acquired, or like we had just had a big win with Coke, COKE, mid cap, small cap. Bottler announced a big share repurchase. We don't want to be in that stock and write a covered call and cap your upside.
Right.
But if you're in some gigantic company like Chevron and your price target's a little bit above here, you can safely write calls. And even if it gets called away, take a gain. So we use individual call options for the large cap, index call options for small cap.
Okay, now the small cap. Let's talk about that. It's your newest product offering. I'm a small cap guy from way back. I cut my teeth on small cap back in the 80s. I was about 3-4 years old at the time. You guys are bringing out a small cap offering at a time when small caps are way out of favor. Everybody seems to hate them because we're all looking at NVIDIA. So let's talk about kind of small caps, the asset class overview, and why you're moving in this specific direction now. And again, as always, counter to the prevailing trend.
Right. Well, the first thing is the macro piece of it, which is small caps are perceived to be higher risk, and many are, and therefore they tend to do poorly during Fed tightening cycles. There's kind of an overstatement of the case that they have more interest rate risk, which is not generally the case. There's of course some companies that do. They tend to be have pretty low leverage. But it is true that when rates are rising, then there's fears that we're going to have a tightening cycle, and then people sell small caps and buy large caps, which tend to be tech stocks. Okay. So they're kind of they trade up when rates are rallying, trade down when rates are going higher, when bonds are rallying in the former. But so that's kind of the macro outlook. We think the tech stocks are going to do well this year, already have, but during the summer, if we're right about these rate cuts, rates should come down. That should benefit small caps. And small caps are very cheap right now, trading about 15 times earnings versus the market 21. But normally those two numbers are similar. So cheap asset class. And the reason generically small caps have actually outperformed the market over long periods of time, not the last 3 years, is that they tend to grow faster because they're smaller. As I mentioned before, they can easily be acquired because that's what larger companies need, is smaller companies to do what they call tuck-ins.
Right.
And then also we think we add a lot of value because unlike, if you look at any large cap stocks, they'll probably, between sell side and buy side analysts, probably be 20 to 50 sell side analysts, and then of course all the buy side. But with small caps, like I mentioned, COKE, there was no research on it. So we have a big advantage because we're doing the models, talking to company, researching it. And so that's a place where we can add value. And we do think domestic exposure is good right now because even though global stock markets are doing well, they're correlated with the US. We think the fundamentals are probably better are better in the US. And then there's one other element, and that's one reason why we've done well with SCAP since we launched it last year, is that it's very, very important with small caps to stock pick. Same thing, a little bit the opposite with large caps. You can just go, buy at least the top 100 S&P companies. They're all going to be profitable, most likely trading at some reasonable multiple. Maybe not in case of Tesla, but usually trading at a reasonable multiple. But that's not the case with small caps. So if you look at small cap universe, there's a very large percentage of companies that have negative earnings. It's about 37% is the data we show here. And if you just adopt one thing out of this webinar, is don't invest in money-losing companies. That should be for venture capitalists. Wait for them to become profitable, then invest.
Right. I always call it taking out the garbage in small cap, and we share the exact same theory on this. Now, that makes, by the way, because today prevailing argument, why don't I just buy the index? Just go out there and buy, and that you're making the argument, because when you buy that index, you get a lot of garbage with it. Now,
exactly.
Can you talk a little bit about your research process for small caps? How are we digging in and finding the likely takeover targets, the really attractive stocks that are going to go into this index and help drive returns for folks?
Well, yeah, so we do search the whole Russell 2000, and so we're looking for profitable companies paying dividends, substantial dividends, usually over 1%, not always, but usually over 1%. That are trading at reasonable multiples. We call it the PEG-Y ratio. So it's the price to the earnings growth plus yield. Normally, you can ignore yield, but a lot of stocks that we buy are like utilities. The yield's substantial. So you don't want to say, I'm not going to buy Southern Company because it only grows at 7%, but ignore the fact it pays 3.5%. So it actually has a total return the same as the Dow or the S&P. So you can't ignore the yield. So we screen for that PEG-Y ratio being reasonable. So below the market right now is about 2 times the growth rate plus the yield. And we also want low leverage, good dividend coverage. Obviously a moat or a competitive business where they have proprietary technology. And what we found is when you do that, you do avoid blowups. You tend to capture these companies that are beating earnings, and then the earnings is driving the stock prices higher, and that's why that fund has done well so far.
You've had the fund up running for about a year. Just to go off script just a touch, are you seeing any major, kind of trends, industry concentrations, anything like that happening in small cap?
Well, the main thing is just that, a lot of their companies have had events like the Coke repurchase, and they do have great business models, so they're beating earnings, and so it's easy to relatively straightforward, to pick. They trade at reasonable multiples, so they beat earnings. They trade up. They're not like the expectations aren't too high. In other words, so it's really proven to be, rather than being a sector bet, like, oh, we've got to be all in tech or all in financials or all in REITs. It's really been more the individual securities being attractive, being cheap relative to larger caps, and having all those characteristics we mentioned.
Okay. And you really focus more so than most small cap managers, by the way, on quality. I mean, you're really looking for the better companies with quality businesses so that you're removing the operating risk, I'll call it, from your selections. Is that a fair statement?
Yes. And also it's fair to point out that, we only have 60 companies.
Right.
So, if you buy 2,000, you're going to have tons of blowups by definition. But if you curate that down to 60, you might make a mistake. We will make some mistakes. They're likely to be smaller mistakes because you picked the ones at reasonable prices with all those quality characteristics, to summarize it. And so you reduce the probability of having really bad companies, which can really destroy your returns.
Right. So a lot of what you're trying to do here is to do well by not making the mistakes, which is that's very Charlie Munger-esque, is right. If you can avoid the blowups, then the rest of it can almost take care of itself.
Yes, that's critical. And we do think that most of the blowups do come from, people either buying money-losing companies or overpaying for growth.
Okay.
I mean, we're not a big fan. I mean, just to pick on a large cap because it's easy. But for instance, Tesla, Elon Musk is a visionary and great stock promoter, but just trades at a 60 multiple for an auto company. That might work out, and he's selling the driverless, but it's already way off its highs. So we try to. It's not relevant to small cap fund, but that's a good example where it's company everybody knows, a lot of people are excited about it, but you can definitely blow up because expectations are sky high for it.
Okay, now just moving on, you're doing something unique. Right? Look, like on the slide that's on the screen now, financial metrics. You're 10 times earning versus the Russell at 17, lower debt, much higher yield. You talked a little bit about the sell and the calls, and we're going to come back to that in a second, but you're doing something else with preferred stocks and a little touch of leverage to boost the yield in the small cap fund. That's unique. It's interesting, and I think it adds enormous value. Touch on that.
Yeah, so with SCAP, we run 10 to 20% leverage, and we do that dynamically. So we started out at 0. The market continued to get better for small cap stocks. So right now we're more like 15. And then, so we think that adds more income. And then also when we write call options, we write it just for the small cap fund on the Russell 2000. If you just buy an index call writing fund with no leverage, you're almost certainly going to underperform the stock market as a whole. And not to pick on anyone in particular, but if you just go look at the returns on all the index call writing funds, they're not using what we call HI or human intelligence to do it, just mechanically doing it. So like actually our head of research asked me today, well, should we rate our normal index call that's out 6 weeks on IWM? And I said, well, we're constructive on this NVIDIA report. We might be wrong, but we are. So why don't we wait till Thursday to do that when the market might be higher? Maybe incorrect, but we're at least analyzing it. Whereas an index call fund will just do it every month regardless of market conditions.
Yeah, and I will note that if you go back and look at the long-term performance of just index writing strategies by themselves, the automatic strategies, if you go and you take the numbers off the SIBO, they're not great. But adding the human intelligence, which I've watched you do in real time in several of your funds, I think adds tremendous value. And then you're also adding the preferred stocks. Now, are you favoring any specific range of preferred stocks? Or
Well, we do have some mandatory preferred. So like there's um, a NextEra Energy preferred R. So that really acts more like a common, but gets you enhanced income. And that company got way too oversold in our opinion. Of course, it's running now with all the utilities,
right,
but we got way oversold. So that's when we added it. So we have some mandatories, but a lot of preferreds, and it's really our best ideas from PFFA, our preferred stock fund, and PFFA is a top performing fund.
right.
So we don't put 200 ideas like PFFA has 200. So we take our best ideas and put it in there. That significantly enhances the income.
Okay, now just so I don't leave anything out, what else because this is an exciting, interesting, big value add product in my eyes, because small caps are dramatically undervalued relative to large cap, relative to the potential of large cap stocks going forward. So there's a real wealth building opportunity here. I don't want to miss anything. What else do folks need to know about SCAP and why it should be in their portfolio now?
Well, I would say it's a little bit also just a, footnote that the thesis is that, that small caps are a great asset class because of all the reasons we mentioned. They are highly cyclical. And if we're correct, but only if we're correct, they will outperform. And everybody believes this. This is not our non-consensus call. Tom Lee has a 50% upside for small caps, which I think is too high. But we have to be correct about the asset class because we're going to be correlated to the small, even though we hope to beat it, we're still going to be correlated to the Russell 2000. And so we have to be correct that the Fed is going to cut rates. The long-term rates will at least rally below 4. So that's kind of like the key call. We do think our fund will, because of this selection, will continue to do well relative to the index, but we can't control the market as a whole.
Right. Okay, so let's move on from small caps now, because otherwise we'll run out of time and everybody will be mad at me for that. So let's jump into high cap, large cap, high dividend stocks, and again, there's all sorts of dividend ETFs out there and dividend strategies. And for most of my career, they've shared something in common when you do it in an indexing or large fund approach. They underperform. You're doing something different that has outperformed. So let's talk about how ICAP and Jay Hatfield approach large cap dividend paying stocks.
Well, we do the same process. So we're looking at reasonable multiples of growth plus income. We do use our macro work. We've had a call that we've stated publicly since even the fourth quarter of last year, which was that investment banks would outperform in the financial sector. So we do use our macro for stock picking. And, our biggest position is Goldman Sachs, and it's been doing really, really well because we were correct. I used to be an investment banker, so I understand how that market works. And so we're selecting stocks with macro outlook in the background. But I think where we feel like we add the most value, and it requires a tremendous amount of work, it's what I already mentioned, which is being very, very selective about companies that you write calls on, where you think that the stock is closer to fully valued, where you have a gain, and doing it very short term so you get a lot of decay. That's what you want, is decay of options. Generally, you don't want to buy options. There used to be, won't pick on anybody, but people who came on CNBC and always recommended buying call options. It's very, very difficult to make money because you're stacking the odds against you. But if you write short-term call options, worst case, your stock gets called away, hopefully at a price that you want to have it get called away, because that's what we only write when we have a gain and prepared to sell it there. So we think we can add a lot of value that's difficult to replicate by individuals who don't work full-time on their portfolios to select these call options, add extra return, and some of that gets translated into income, but a lot of it's just alpha in terms of the total return. So we think that's the key edge. You can stock pick, and that is important, and we make good stock picks, but it's not as important as it is with small caps, because as I mentioned, there's not a lot of terrible large cap dividend stocks.
Right. There's really not.
Like, like I'm picking on Tesla, maybe you don't agree with that, but they don't pay a dividend. So it wouldn't be, it's not like we're avoiding Tesla, and that's a great call. So the stock picking is important. We have a preferreds. We run modest leverage, 20 to 25 of that fund. That enhances the yield. But I think we're hoping to produce the real alpha is being very, very thoughtful about writing these very short-term options.
Yeah, I want to touch a little bit more on the option strategy, just not too much, but a little bit, because it is different how most people are doing this. You're not just blindly writing calls on your whole portfolio. You're going through, you're looking at stocks. We're like, okay, Southern Company is within a point of my exit point where I think it's overvalued. And if it gets called away here, I got a nice gain. I'm not going to be mad. So you're doing that. How far out to find short-term options? How far out are you going?
We only do it on companies that have weekly call options. And typically it's 1 to 3 weeks out. So we have tremendous, very significant theta or decay, that's a technical word for decay, because that's what we're really targeting. Is we don't want to limit our beta. So beta is the sensitivity to the stock market, because the stock market goes up on average around 10%. So if you reduce your beta, whatever you reduce it by, you're going to have 10% less return on that amount.
Right.
So we want minimal impacts on beta, but a lot of decay. So every Friday, even though it's not the monthly expiration, we'll have a lot of expirations. And then that frees, even if something gets called away, then that frees up capital and we can replace it. Because the reason that we particularly like ICAP for writing individual calls is that you mentioned Southern. I do think Southern's pretty, fairly valued now. So what it also ends up doing is you get called away out of sectors that might be overvalued. We think people got a little bit too excited about the internet requiring electricity because these are regulated companies and they really don't have that much upside from it. I mean, rates are rallying, so that helps. But then we don't have to just go buy another utility. We can go buy an undervalued MLP or an undervalued REIT or an undervalued, where we could say, well, IBM is cheap. We don't particularly believe that's the case, or add to our Goldman Sachs position. So you don't have to just, get called away from all of your utilities that are all overvalued, and then you can't recycle the money into anything else.
Sorry about that, Jay. I had to turn away for just a quick second. All right. So from the large caps, you're using a very unique strategy. Let's talk about MLPs, because you are by far, that I'm aware of, the best performing MLP ETF on the market today.
Yeah. So MLPs, we use the same approach. We model every asset, come up with relative value. So we have our proprietary picks. With MLPs, we rate a smaller amount of call options than we would for ICAP. And the reason for that is it's sort of the opposite of what I just said, that it is true. Like if you're getting called out of your energy transfer, you could say, oh, well, I wanted to sell that, and I wanted to buy EPD, Enterprise, but they probably both ran up together. So Enterprise really isn't that, isn't cheap relative to the energy transfer. But so we do a smaller amount, do target more like 2 or 3% return a year from that. And then we are a corporation for tax purposes. So it's much simpler to buy a corporation and get 1099, don't have to file a K1. And then also you get better capital gains treatment. When you sell, you get something called recapture, which is pretty heinous. When you sell an MLP, your dividend, the cash, most of the cash you got gets treated as return of capital, and you get taxed at ordinary rates. That doesn't happen with our corporation.
Right. Now,
so you get a lot of tax cleanup from that. We do run modest leverage, 20, 25, but same thing, we actively manage that. We took all the leverage off during the crash, during the pandemic. And that's one of the main reasons we outperformed. Some funds went out of business, but we've outperformed because we also added the leverage back, not in a crazy way, but slowly once the Fed intervened. So we've stuck with MLPs. A lot of MLP funds are now half utilities.
Yes, indeed.
And so the MLPs were way undervalued compared to utilities, so they lost all that return. Now, you could argue they're closer to fair value, but we think it's better just if you want an MLPs, you get an MLP fund. You don't buy a fund where you get half MLPs and half utilities.
Right. Now I want to hit something hard before we move on, because we've still got to wrap up the preferred stock section of this, which is important. But when you buy this ETF, it's top performing ETF, fantastic dividend yield, but the tax conversion here is really big. If you've ever filed the tax return where you had 6 or 7 K1s and had to deal with that every year, and then the recapture on the other end can be a nightmare. And all that kind of goes away through accounting magic when you use an ETF to own the MLPs. So I really wanted to hit that hard on the tax side. Now, the other important thing on MLPs, it's not really that dependent on the price of energy itself, is it?
No, it's not. And what's nice about it is that that's always been the case. Of course, if volumes go way down, that's bad. So when oil was negative $37, that's not great for MLPs. But the volatility has dropped because it can be, energy volatility in pure energy stocks like Chevron producers can be disconcerting. So now MLPs are about half as volatile. And the other element that's actually good to have this chart on here is that it's a good diversification to your income streams, because large cap dividend funds, even though doesn't really make sense, they are correlated with interest rates. We already talked about small caps being correlated. Preferreds are correlated. MLPs are not. So they did really, really well, even though rates skyrocketed from 21 to now, partly because they're catching up, but also they're more viewed as like inflation hedge, energy derivative, not as volatile as energy. So having said that, if we're correct and rates rally, then MLPs will do fine, but they may not keep up with their higher interest rate brethren. But on the other hand, if we're wrong, it's a good hedge. So we would recommend you have that in your portfolio. But if you're just looking for the thing that's going to really skyrocket, MLPs, I think MLPs, I'll just say, are up nearly 20% already this year. So it's not like you're making this big contrarian call on something that's terrible.
Right. Now, just real quick before we jump into to polish off with preferreds, a big part of MLPs is going to be natural gas demand. And when you look at, there's a chart in the deck on, natural gas has gotten crushed over the last year. I'm quite bullish on the demand, and I think you are too. Can you just kind of go over a little bit of natural gas demand?
Yes, so that's a great point. That really, the lower the price in the U.S., the more needs to be exported.
Right.
And I always like to look at like a map from 200 million years ago. There was a huge ocean in the middle of the United States. That's why Utah is all red. And that means that we're the biggest onshore hydrocarbon source, and a lot of that's natural gas. So we're the Saudi Arabia of natural gas. We probably always will be. There's always a new zone to drill, and that's a huge growth opportunity for most of the major MLPs, because they transport the gas down from the mid-con or central part of the U.S. down through to the Gulf, and that's getting exported. And by the way, I should have mentioned it, because sometimes people accuse me of being like anti-environmental, but it's sort of the opposite. I actually wanted to improve, not just like score political points. And so the best thing we can possibly do for the environment in the short run, not just carbon, but all the other pollutants, is get rid of all the coal and supplant it with natural gas. Yeah, that's a huge growth opportunity in the U.S.
I think you and I should come back here on Benzinga one day and just do about 2 hours on energy, but we don't. But we do have about 6 minutes left to talk about preferred stocks real quick, where you guys are doing something with PFFA and PFFR that is completely different than just about every other preferred stock manager. So let's talk about the way you're managing the preferred stock portfolios and why folks should absolutely have these in their portfolio.
Well, the important thing to remember is most preferred funds, so PFF, we kind of did ticker arbitrage and added an A to PFF's the biggest fund, about $15 billion. That's passive. And it's okay to own passive funds like the S&P 500. It's totally fine to own that passive market cap weighted fund, because those are equities. So actually being market cap weighted is good because you end up with more NVIDIA, the more successful companies. Every once in a while, like, not to make this the Tesla pick on webinar, but you get a few stocks that might be a little bit overvalued, but there's unlimited upside, so you don't have to manage all the risks of preferreds. So preferreds have call risk, so they're callable at $25. You have to sell them when they hit their price.
Right.
They have interest rate risk with equities down. To manage that, we have more fixed to floating, so we're getting big bumps in our income, and that's the main reason we've outperformed is we have lower interest rate sensitivity. You have to manage credit risk. The default rate, you can actually almost buy everything and be okay on defaults, but you want to try to avoid the First Republics and the Silicon Valley banks, which we have. And so you manage those three risks, and then it's pretty straightforward to beat the index fund because they're not managing it. Oh, and also we're not cap weighted because cap weighted for fixed income is the opposite of equities in that when preferreds rise, their capitalization goes up. That means they might be above par. So instead of adding to it, you want to sell it. The ones that go down, if they go down and there's not a huge or significant credit risk, then you would actually buy more. So the index funds do the opposite. It's okay with equities, like momentum's a good factor for equities, but not for fixed income because they have a limited upside. And so it makes it imperative that you have active management. That's proven out in terms of our fund. PFFR is just an index fund that we do think REITs are an underappreciated and underrated by the rating agencies sector. Very low default rates, low leverage. Everybody has hated them over the last 2 years, but they don't look the actual assets. And so we have that fund that is, just run as an index. It does have a provision to sell securities above 25, so that's some smart beta.
Right.
So that's just a simpler way with no leverage to play the preferreds.
Okay. Jay, I think we could have probably gone another hour at least here today, but we are kind of running out of our allocated time. So I'm going to call the moderator back in and just turn it to you, Jay, to say, do you have any final thoughts before the moderator Benzinga takes our platform away from us today?
No, I would highlight two things that I would have as your key takeaways. Never ignore the money supply. We give you that data on our website. Hopefully we'll get into next 2 or 3 years where you can't ignore it because it's not going up 60% and down 15, creating volatility. So don't ignore the money supply like the Fed does, and you want to do these huge mistakes. And then if you do pick your own stocks, follow what we outlined, which is try to avoid money-losing companies trading at multiples that are substantially higher than their growth rates, more than the market. If you do follow those two prescriptions, then you're going to stay out of most of the trouble.
Awesome. Well, hey, I appreciate both of your time. I think you had, I love trading options, especially to minimize risk. It's not the first thing I learned when I was learning options. I like a lot of people that you might know where it's like, oh, calls, buy them, right? But like you kind of alluded to earlier, Jay, where it's like, that's not statistically speaking, right? In terms of, hey, the casino wins because they have that 2-3% edge. Buying options. And I think I know who you're referring to on the CNBC side of things, but it's exciting, but maybe not for your wallet. So I love the different strategies, as you pointed out, Tim, that, Jay and team use to minimize the risk, but also to capitalize on those gains, just a couple of percent. And you're happy if it's called away. You're like, you know what? It was already up. I believed it was at a fair value. And I just got some extra juice from it as well. And I think the data decay aspect of it is key as well. But thank you both so much. Tim, thank you so much for being our lovely host for this. And Jay, to you and your team, clearly, you guys know what you're doing. And the small cap, I think it's such a scary world. This is my final thought on this before we wrap up. It's a scary world because there's not a lot of research, as you mentioned, right? So your team went out there and did the research on the companies as well. So it's kind of like who's good, who's bad. And yeah, I agree that they're kind of significantly undervalued compared to the other stocks in the market. So love what you guys are doing with that fund and look forward to having many more of these conversations in the future.
Thanks, Sinead. It's great.
Absolutely. And thank you, chat, for being active. I know we had a couple of questions in there. We try to bring into the conversation, but we'll see y'all next time. Take care.